Hello, Jay. Hello, Terry. How are you guys doing today?
Doing pretty good.
Jay. How you doing?
Good. It's a very volatile market, and I saw the index has been a whipsaw kind of thing, and there's a lot of things to discuss with you guys today. So how about we get started from the data drop today, the PCE report. So the PCE data shows that the Fed's inflation got broached 2.5% in June from a year ago, in line with the expectation. What do you guys think this will have the implication to the FOMC decision next week?
I could start this one off. If you want, you can respond.
Sounds perfect.
All right. So we've continued to see the path that the Fed said they wanted to see, which is a series of data points that increase their confidence that inflation is eventually set to move back down to the target zone. I think we can say at this point that they're probably feeling very comfortable right now. We didn't see, it's the core PCE that they really look at, but across the board, it was another print that's going to be right in line with what they're looking to see. And when you look at the unrounded numbers, it was even better, both for core and headline. So I think we're sitting at a point where cuts are going to start happening even if we don't see significant weakness. And right now, it looks like the Fed funds futures are pricing in at this point a September cut, a November cut, and a December cut. Jay, you want to pick it from there?
I would pretty much agree across the board. I'm just kind of breaking down into the pieces here. You saw goods prices, they fell 0.2%, while service prices increased 0.2%. Housing related prices, they were up 0.3%, but that was a deceleration from the previous months. So as Terry was talking about, numbers are trending in the right direction. I think the one thing that we could probably put to bed from the fact that these numbers came in a little bit more in line was the idea that there was some whispers of the Fed cutting rates next week at the July 31st meeting. They got the two-day meeting on Tuesday and Wednesday. I don't think that that's going to be the case, and I don't think that this data lends itself to the idea that that'll be the case. I think what we'll see heading into next week is the Fed looking at this data kind of upbeat. Big words that we're going to want to watch for in that Fed meeting is they've been using the term elevated to discuss their inflation. Look for that to get dropped, which would be the first signal that they're getting started, ready to move. I think that we'll see Powell strike a little bit of a dovish tone in there, talking about some weakness in the economy, but inflation trending in the right direction. But let's not forget that Jackson Hole in about 3 weeks' time, and that could be a time where we've got the jobs number next Friday. We got CPI in about 2 weeks coming out. If they come in weak, then I think the Fed signals that rate cut coming at the Jackson Hole meeting for September. The only thing that I would say, the idea that CME Fed funds futures are pricing in 3 rate cuts through the end of the year, I do think that that's going to end up being a little bit too aggressive.
Got it. I saw your article yesterday, and there's the news that former Fed Dudley pointed there need to be rate cut, like upcoming policy meeting next week, which is in July. What do you think about that? Is that possibilities?
No, as we're just talking, number one, Dudley doesn't have a vote, nor is he in the room to argue his point, right?
Yeah.
They get a lot of press, and he had a good track record at us. But again, he also, the biggest thing for this, I guess, would be that he was one of the big hawks there, saying that the Fed shouldn't be cutting rates, and now he flipped. So from that perspective, yeah. But outside of gaining a lot of press, he doesn't have a lot of influence on the Fed, so I don't see that really impacting him. Terry, I know you got some thoughts on this.
Yeah, I think that my experience with Dudley over the years is a lot of times he likes to be in the headlines. He likes to say things. He likes to take risks. He likes to make a controversial call. He likes to take an outlier call. And his name in the press, it keeps him on the speaker circuit. And I think I really don't take this as a serious comment. He's going to look like a genius if we start to see growth, the bottom fall out, and everybody says the Fed moved too late. So that's a kind of move. I do not believe that this necessarily reflects what he would do if he was a voting member right now. And I've seen that from him a number of times.
Oh, got it. I see. Let's move to the market. So last week, the market has been a major pullback. And if we look at SPY, it's now pullback to this trendy line, the support level. So I think the pullback would last. Is it just recent, or it will continue?
Base case that I have, if I start, is been looking for a consolidative period, but not a major top. A period where we are going to start to kind of bounce and let things rotate, a lot of rotation. Our signals, every time you start a pullback, the first question is, what are the odds that this is a major top, or should I be picking my points where I'm going to start to use it as a opportunity for better entry prices? And if you look at what just immediately preceded the pullback we see here now, we've seen a big expansion in breadth and a big rotation into areas of the market that were lagging. Particularly small caps, that's a big example, or regional banks. There's a lot of different areas that suddenly started to catch fire right before we started this pullback. And also, this pullback comes off a point where we were overbought in a technical sense on 5 different time frames simultaneously in the S&P. So there's no reason to think that we have a big top. I think that there's a lot of excuses for the market to have some kind of pullback and profit taking, but underneath the surface, breadth. Anyways, we've been building a stronger foundation for the market, and I think this really could be. There's a number of studies that suggest the posture we're in augurs for a 2 to 3 month consolidation and then additional upside, which is my base case.
All right, agree with everything Terry said there. That's how I'm kind of at it. So looking at yesterday's lows, the NASDAQ fell 10% from July 11th to yesterday's lows. S&P nearly to a T, 5% from July 17th to yesterday's lows. Both obviously corrective moves when you get 5 and 10% numbers put there. So it's not for us to see the first couple of weeks of earnings kind of differentiate trend. You don't have stock buyback programs going in. They start coming back into play. July 19th was when they started to filter back in the blackout periods. So that's getting priced in here. That flush kind of washed out for the short term. And then once you had that, you had people looking at, okay, we got PCE up. We've got a ton of big earnings reports next week coming up. And we'll talk a little bit about them in a second. And you also have the Fed where, people were talking Fed. So once you had that flush, you had buyers willing to step in, as Terry was talking about. You got a little bit of a better value going in here, right? So, I think a lot definitely depends next week. Next week is arguably the most important week for us going through into August and into early September, where you got Apple, you got Amazon, Microsoft, Meta, ARM Holdings, Intel. I mean, just a slew, Qualcomm, just a slew of big tech names coming in and expected to post some really good numbers. And then you also have, again, the Fed. Be interesting to see react to data. We got ISM services, the PMI manufacturing on Friday. So just a big week of macro and micro data. And I think that the market wants to get a sense of how that's going to be before choosing the next direction. And if we keep getting kind of like those middle lane speeds, little cautious guidance, I think it does set up for a little bit of a choppier atmosphere in the next couple of weeks. But one that I start taking a look at is that seasonality that starts coming into play. And usually that's right around end of August, early September. Now, if there's the aspect of a Fed rate cut coming in, I think a little bit if these reports come in nicely over the week and we don't see growth falling off a cliff in any of the jobs numbers, then we could get a drift higher up into the Fed decision to cut rates, and then perhaps a little bit of a spike blow off top that starts leading us into some of that seasonality. So again, next week is going to factor in largely. Like, I think a lot of people hoped that Alphabet and Tesla would help things this week, and they obviously didn't. So if we see a number of underperformance from the mega cap tech names, that could raise a little bit of a red flag.
Yeah, and I just want to add more things. Seasonality is a really important idea. I've done a lot of studies on this, and a lot of people have done a lot of studies on this, and it really is remarkably consistent over the long sweep of history, that when you start to get into August and September, you start to get into a period that's more crash prone, more consolidative, more corrective, all the way through the second to third week of October. And once you get to the last week of October through the end of the year, you have the seasonally strongest period historically for the market. And that lines up really well with having the market overbought on 5 different time frames at the end of July. That's exactly sort of type specimen year for the S&P, where, now perhaps with the highs retest, go back down to the lows of this consolidation, maybe move back up a little trading range with about 5% range, and maybe we test the bottom, take out some stops before moving higher into the end of the year.
Yeah, and just a discussion there. The 5-year S&P for August is up 0.4%. For September, down 4.2%. Again, this is a 5-year average. It's been down in September the last 4 years running, and then up in October. But usually that bounce comes towards the second half of it. That's when we start getting the Q3 earnings. And the other element that gets factored in is there's a lot of money market funds that have their year close in October. So there's some harvesting, selling that goes on that factors into that. This year, we're also going to have that added issue of elections, but generally it's been positive for the markets. They haven't really, I know this year could be a little special given the heightened sensitivity around it, but yeah, I mean, this is on the road. But, for the near term, next week's tech responses, what Powell says and the jobs number all factor in.
Yeah, just on the election, I mean, generally speaking, that slightly push back that window, but because you have the uncertainty, right? So you normally it's the last week of October when you enter the seasonally strongest period. The last week of October, all of November, all of December. That's your seasonally strongest period. Think of it as like, roughly on average. But when you have it here, you're talking first week of November, you still got uncertainty. So you bottle that pressure up. And it really doesn't matter what the outcome is, typically. It is the release that happens when you take away the uncertainty. Markets figure out a way to kind of assimilate whatever the realities be. And everybody's going to talk big, first get into office or they first get elected. It's just getting the uncertainty out of the way. So this year could be where we push that window back into about a week into November, right after the election.
Got it. And other than the home market, recently the semi stocks has been relatively weak. Like if we're looking at NVIDIA, for example, NVIDIA has dropped below this bearish flag and below the previous support level. So do you guys think the AI play investment still holding for the coming year, and it's a good time to buy the dip of those semi stocks?
I can tackle that one first. Number one, semiconductors tend to be very cyclical in nature. Now, obviously, the cycle's a little different because you got the AI involvement. Now, not everybody is involved in that. Not everybody's a beneficiary, and we'll kind of talk about in a bit. But from my perspective, months in front of the downturn, and then about 6 months, when there's upturn. So there is an element that priced in, certainly some profit taking going on here and moving into other cyclicals. There's definitely concerns, wars and tariffs and blockages by both for that matter. So that's but AI cycle I think is going to take a little while to play out. So I am definitely very intrigued to buy some of the dips in some of these names. NVIDIA certainly being one of them.
Got it. And in terms of the Google stock, which had the earnings this week, Jay, I saw one of your articles that it seems Google's earnings not that bad. It's pretty good. So the price action is probably a result of profit
taking, and there's a key element from it that they talked about on the call, which came after this article, came as piece, and that was their expenses. And this kind of goes to the idea that semiconductor slowdown, where a name like a name, their price, and people have had to pay up for it. And you're seeing the impact of that with Alphabet, where their expenses, they were projecting them to be up, I think, 90%, while revenue growth is going at 12%. And that's the element that's an issue here with this AI build out, is that not everyone is on the winning side of the coin right now, and that, margins are going to get, there's that demand for cloud, which cloud was the strongest from the Alphabet earnings report. But just to develop and meet the demand for AI from their customers. And Alphabet really showed that. One of the reasons why you're just seeing this drifting lower here. Now, again, Alphabet I think is going to be a good buy, but it's one element that people are going to have to start parsing through the winners and the losers of AI. And another reason why you're seeing these semiconductors kind of roll over a little bit, from the idea that not everyone's going to be able to afford these, and they might put off some purchases until they have a best of their return on investment. I don't know if you got any thoughts on this.
No, I mean, you're the best on Google. Advice.
Thank you.
Yeah, I like the impact started from deep last week and this week, and looking for the long-term return. And I also agree with you, Jay, about AI, like about in the long term.
And I was just going to add, Alphabet kind of shows what's been playing out in markets, and that is when a stock gets hit on their earnings, we have not seen people rushing in to buy the dip. Dexcom is a perfect example this morning. Nike from a few weeks ago, that's been trying to fit. And, we've seen once earnings leads a little bit lower. So I do think that the watch out in Alphabet creates a nice buying op.
Got it. Yeah, my Nike and Lululemon are underwater now. Probably gonna take a long time for the consumer expenditure stocks to get back.
Yeah.
Their current situation.
Especially if next week's jumping light.
Yeah. Well, I would say the most recent retail sales beneath the surface, the strongest one we have seen in a year in the U.S.
So that's for the macro, the PCE data, and the market outlook, and also the semi sector, and also the tech stocks. Thank you, guys, Jay and Terry, and look forward to talk to you guys again.
You got it, Sherry.
Thanks, Sherry.
Yes.
Take care, Jay.
Yeah.
You too.